Ever get hit with a stack of mortgage paperwork and think, how does anybody actually understand all this stuff? What if you could look at any deal anywhere in Boston and know exactly what every single number means, so that you don't get blindsided at closing or miss out on cash flow? I'm Jarrett Lau, founder of Profitable Properties Boston. I own over 50 cash flowing properties in the city, and I've been through every single type of financing that you can imagine. If you want to invest smarter and keep more of your money, you can stick with me, because today I'm going to be making mortgage math very simple and showing you exactly how to use it to your advantage. So let's kick off with a story. A few years back, I helped a first-time investor buy a triple-decker in the greater Boston area. The deal looked perfect till the closing table, when a hidden prepayment penalty and 2 points in extra fees nearly killed his returns. If we hadn't known what every single line on that document meant, he'd have left thousands of dollars on that table, or worse, backed out and missed a huge opportunity. That's why you need to master these key mortgage terms. So let's break them down using real numbers, no jargon, and a couple of tricks to help you negotiate better every single time. First up, we got principal. This is the amount that you're actually going to borrow. So you're buying an $800,000 building and you put $200,000 down. That leaves you with $600,000 in principal, your starting loan amount. Next, we have interest rate. This is the bank's charge to lend you money, expressed as a percentage per year. Even a half of a point makes a huge difference in the rate, can mean tens of thousands of dollars or more or less in your pocket over the life of your loan. Amortization. This is how your payments are spread out over time, usually 15, 20, or 30 years. The longer the amortization, the lower your monthly payment, but the more in total interest that you're going to pay. It's going to be a trade-off. More cash flow now, or more savings in the long run. Term. Here's where it gets tricky. Your loan term is how long before your balance is due or needs to be refinanced. Sometimes your term matches your amortization, but often with investment properties, you're gonna probably get like a 5 or 7 year term on a 25 or 30 year amortization. When that term ends, you're either gonna renew at the new rates or you're gonna pay off the balance, so plan ahead. Points. Points are going to be upfront fees paid to the lender. 1 point equals 1% of the loan. On a $600,000 mortgage, 2 points are going to cost you $12,000 at closing. Sometimes points are going to be worth it to secure a lower rate, but you need to do the math, because sometimes it's just money outside the door. LTV, loan to value ratio. This is the percentage of the property's value that you're borrowing. If your loan is $600,000 on an $800,000 property, that's a 75% LTV. Lower LTVs mean you usually have lower rates and easier to get approval. DSCR, debt service coverage ratio. This is huge for investors. Lenders who want to see that your property's net operating income covers the loan payments, usually by at least 1.2 times. If your property brings in $6,000 per month and your loan payment is $5,000, your DSCR is going to be 1.2, right at the cutoff for most lenders. Prepayment penalty. Watch out for this. Some lenders are going to charge you extra if you pay off or refinance your loan early. Always ask about prepayment penalties and check your documents before signing, so that you're not going to hit with these surprise fees when you try to reposition or sell the property, especially if you're doing flips. Escrow. This is your money that your lender sets aside to pay taxes and insurance, so that you're not stuck with a massive bill once a year. Keeps your cash flow predictable and your property protected. Now let's talk real world impact. Do you remember that investor that I mentioned? By understanding DSCR, he negotiated a better rate and avoided a loan that would have probably squeezed his monthly cash flow. By spotting the points and the prepayment penalties up front, he saved nearly $15,000 in unnecessary costs, money that went right back into his next deal. But here are the mistakes that I see most often. Focusing only on the interest rate and ignoring things like points, fees, or terms. Forgetting to check that DSCR and then getting denied by the lender at the last minute, especially if numbers are tight. Not planning for what happens when the loan term ends. Overlooking prepayment penalties that kill flexibility when refinancing or selling a property. And if you want to negotiate like a pro, you're going to need to see the whole picture. That's why I put together my mortgage cheat sheet. It's a one-page guide with every single term, a calculator for running your own scenarios, and a list of my most trusted local vendors for Boston investors. If you want it, just comment mortgage in the comments below in your city, or DM me directly, and I'm going to do my best to respond to every single message. Don't forget to subscribe, because in my next video, I'm going to be walking you through how to compare lenders' offers side by side and how to spot the hidden costs before that you sign anything. I'm Jarrett Lau with Profitable Properties Boston. Invest smarter, keep more of your money, and I'll see you in the next video.